Welcome to vTalkInsight, Market Drivers Daily for February 13th, 2026. AI is now driving big swings in growth expectations, sector leadership, and even traditional hedges, creating a very different market tape beneath steady index levels. Let's start with how the AI story itself is evolving. AI has shifted from a simple growth narrative to a complex force reshaping sectors, credit, and policy debates. Recent price action shows repeated AI-driven sell-offs, sharp single-stock moves, and a growing split between perceived infrastructure winners and more vulnerable service models. That makes the AI theme less about one-way upside and more about choosing exposure along the value chain and through time. On the infrastructure side, demand remains powerful. Siemens reports a record €120 billion backlog and has raised its outlook on the back of industrial automation and data center orders, arguing that AI will accelerate, not replace, its industrial software franchises. Memory markets are seeing what some describe as a great memory crunch, lifting prices and benefiting names like Micron and SanDisk, even as Cisco warns that those same costs are squeezing its margins and have knocked its share price. At the same time, large tech platforms are ramping AI capital expenditure by well over $100 billion, in some cases accepting temporarily weaker free cash flow to secure long-term compute and data advantages. Finance and wealth management are leaning into AI from a position of scale. A newly announced merger will create a $2.5 trillion asset and wealth manager, explicitly to gain the size needed to invest heavily in AI, tokenization, and new distribution models rather than rely on cost-cutting. Across the industry, firms are already automating back-office processes, with management teams expecting headcount to drift lower over time as AI improves efficiency. In advisory, AI tools are expected to let advisors cover more clients and assets, but the personalized nature of relationships is seen as a buffer for fees, pointing to gradual, not abrupt, disruption. Beneath that, structural labor shifts are emerging. Some professions, such as entry-level legal work, are already seeing reduced hiring as AI tools take over routine tasks, and there is concern that if job losses are technology-driven, future Federal Reserve rate cuts may have limited impact. Policymakers are reacting. Compute capacity is now doubling in as little as 4 months. New York State is committing $400 million to an AI compute cluster, and there is growing political momentum for rules on workplace impacts, child protection, and deepfakes. At least one leading AI company is itself calling for tighter oversight, and some market participants argue that trustworthy, well-regulated AI could become a key competitive advantage that is not yet fully priced. Market pricing around AI remains volatile and selective. Real estate services and other high-cost intermediary sectors have suffered repeated double-digit drawdowns on AI disruption fears, even when there is little new fundamental information, while some analysts see those moves as overdone once the initial panic clears. Private markets tell a different story, with Anthropic reportedly nearing a funding round valuing at around $350 billion and major family offices channeling capital into AI alongside green energy and sustainable agriculture, raising questions about concentration risk in a small group of high-profile startups. Looking ahead, the key questions are how far this differentiation runs along the AI supply chain, whether credit markets stay comfortable funding massive capex, and how quickly regulation firms up. For portfolios, that points to an AI theme defined by dispersion and timing rather than broad beta, which sets the stage for how we think about the wider growth backdrop. Stepping back from AI, the macro tape still points to accelerating growth, especially in the United States, but the expansion is unusually capital-intensive and uneven. Recent payrolls, claims, and business surveys show the U.S. labor market not just healthy, but gaining momentum, and the diffusion index of job gains has reached a 2-year high as goods-producing industries post their best performance since 2023. Financial conditions are now the most accommodative since 2022, and equity futures near all-time highs suggest investors see that support persisting into next year. Forward-looking assessments see the U.S. economy accelerating into 2025, with the growth impulse gradually shifting from tax refunds toward the lagged impact of earlier rate cuts. At the same time, strong employment data have pushed market expectations for the first new Fed cut back toward July, and some external scenarios now envisage only a very limited easing cycle. There are signs this may be a job-light, AI-heavy upswing. Recent periods of strong gross domestic product have coincided with weak job creation, and one estimate suggests the bulk of growth is linked to AI capital expenditure and top-tier consumption, reinforcing concerns about a more K-shaped expansion. Fiscal and investment trends are amplifying that growth picture. In the U.S., tax incentives and AI-related public spending are expected to support activity, but they also raise the risk of overheating and more persistent inflation into 2026. New York State's $400 million AI compute initiative is one example of targeted capex that could attract follow-on federal support. In Europe, Germany has already deployed nearly 40 billion euros on infrastructure and defense, while the United Kingdom has seen investment growth accelerate from 1.7 to 3.4% as rate cuts and planning reforms encourage spending, prompting the fiscal watchdog to revise growth forecasts higher. Energy and consumer names are also contributing to the growth narrative. U.S. engagement with Venezuela is allowing Chevron and others to ramp production, with Venezuelan output expected to rise 30 to 40% within a year, which could influence global supply dynamics. Hermes has delivered resilient sales, with growth picking up from 7 to 10% over the year, and is benefiting from both primary and second-hand demand as the luxury resale market expands. In digital infrastructure, Fastly has surged after outlining a 2026 earnings outlook that is roughly double prior expectations, while platforms in the fashion rental space report plans to triple growth by expanding into the U.S. and UAE with asset-light, peer-to-peer models. All of this underpins a constructive backdrop for growth-oriented assets, but the risks look increasingly late cycle. AI infrastructure capex is being funded partly with debt, contributing to some credit spread widening and raising questions about future default risk if cash flows disappoint. Structural slowing in U.S. employment growth, evidenced by negative benchmark revisions, is feeding into a weaker dollar and highlights the possibility that policymakers could misread AI-related labor shifts, either by over-tightening or by cutting into structural weakness. For market participants, the watch points are clear. Upcoming payroll and inflation releases, signals on the timing and depth of Fed easing, and whether high growth corporates from industrial software to luxury and digital infrastructure can keep delivering against elevated expectations. Those dynamics are already visible in today's pronounced market divergences. Headline indices may look calm, but under the surface dispersion across regions, sectors, and hedges is extreme. Recent sessions have seen flat or range-bound U.S. equity benchmarks alongside intense sector rotation, single stock volatility around deals and earnings, and unusual behavior from traditional safe havens. This divergence theme, which has been building for weeks, now spans everything from the dollar and treasuries to luxury goods and banks. Regionally, leadership is shifting away from a decade-long U.S. and dollar focus. Persistent dollar weakness is expected to be a multi-year story, encouraging some global investors to rebalance gradually out of U.S. equities and into other regions, particularly Asia. Liquidity is increasingly flowing from the U.S. into Asian markets, with Asia-Pacific equities, as measured by MSCI, outperforming the S&P 500 at their fastest pace in at least a century. Stronger earnings from Asia and broader emerging markets are reinforcing that trend, while in Europe, indices such as the Stoxx 600 and FTSE 100 have outperformed this year thanks to heavier exposure to commodities, industrials, and financials, and less dependence on expensive tech. Valuations and sector mix are central to this rotation. The FTSE 100, for example, trades around 13.5 times earnings, below the S&P 500 and has benefited from strong returns in miners and banks and relatively low technology exposure, drawing renewed interest from global allocators. European equity markets are also seeing record high dispersion since the global financial crisis, which, combined with reasonable valuations, creates both opportunity and risk for stock pickers. At the same time, many international investors remain wary of adding to U.S. equity and dollar exposure after a decade of outperformance, especially as local currency moves have diluted dollar-based gains. Within equities, style and sector splits are just as stark. Since late 2022, only communication services and information technology have outperformed the S&P 500, underscoring how reliant global benchmarks have been on a handful of AI-linked megacaps. More recently, market gains have broadened at times to include cyclicals such as consumer discretionary, financials, mining, and energy, but there is skepticism about how long they can last as consumer fundamentals soften. Defensive sectors like consumer staples and utilities are rallying alongside this cyclical upswing, a sign of underlying recession concerns and a willingness to pay for business models seen as less exposed to AI disruption, including metals, mining, and agriculture. Cross-asset hedging patterns highlight how unusual this environment is. In a recent AI-driven risk-off move, the Nasdaq 100 fell about 2%, and sectors viewed as AI exposed sold off broadly. Yet traditional hedges behaved inconsistently. U.S. Treasuries attracted inflows, while gold and Bitcoin both dropped sharply. Dollar moves have also been muted at times despite strong data, and long-standing hedges, such as simple dollar exposure, are proving less reliable as diversification tools. Looking ahead, key questions are whether Asia and Europe can sustain their leadership, if U.S. equity breadth can genuinely improve beyond a narrow tech cohort, and how investors rebuild hedging strategies now that some classic tools are less effective. The answer to those questions will determine whether today's divergences narrow through price or through a change in the growth and AI narrative we discussed earlier. To wrap up, AI is now operating as a system-wide driver, creating powerful growth in infrastructure, financial services, and select digital businesses, but also causing repeated bouts of volatility and raising the stakes around regulation and labor markets. The macro backdrop remains supportive, with growth momentum building in the U.S. and key global regions, reinforced by fiscal spending and capex. Yet the cycle looks increasingly capital-intensive, job-light, and exposed to policy mistakes and credit risks. At the same time, dispersion across regions, sectors, and hedges is unusually wide, putting a premium on understanding where earnings, valuations, and diversification benefits are genuinely improving rather than simply following headline indices. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.